Ravi Dharamshi is back, and he's come back at an appropriate time when macros are shaky, rupees at 70, the market no longer are crying, and financial media both locally and globally, we have stopped using words like rout in emerging markets, crack in small and mid cap stocks, and a panic in some of the micro cap stocks. So last time when we interacted with Ravi, markets are a bit shaky, but now they are looking much more stable. So welcome back. Thank you for joining us.
Thanks, Nikunj.
It's a good
Thanks for
time to
having
come
me.
back, right?
Yeah, of course. There's always much happening.
6.5% higher for the Nifty from the recent low. Small cap indices which were down by about 15 to 18% from the YTD high, they've also recovered 50%. I wouldn't say awful has become great, but awful has certainly become bad for the Indian markets.
Yeah. Let me just give you a perspective of how we look at it. So the rally prior to in 2017 was actually a very polarized rally where very few stocks did well. So what we are witnessing now from this quarter result onwards is that actually the ocean, the breadth of the market, the companies that are doing slightly better than what they were doing earlier is actually increasing. So also the fact that mid cap, small cap saw a nice correction towards in the first half of this year helps the fact that now the value is also emerging, and the growth expectations have also aligned a little bit more to the reality. Earlier, the people are extrapolating much faster, and large caps were attractive relative to mid cap. I think now that's where the money is flowing incrementally.
You know, historically it is believed that when there is weakness in the currency, that is an harbinger of weak economy, weak macros, and trouble for emerging markets. But in your latest tweet, you are perhaps proposing a different thesis, that in the short term there could be a sentimental correlation because of weakness in rupee, but in the long term, weakness in rupee is actually good news for India.
Yeah. So historically, if you were to directly correlate the markets and the rupee, it is not like rupee depreciation has led to markets falling. What matters is definitely the pace at which it is depreciating and the reasons for which it is depreciating. Right now we are depreciating because dollar index is getting stronger. Okay, incrementally our macros have also weakened a little bit, but it is not a situation. RBI is focused on inflation, government is focused on reviving the economy. I don't think, and we are not over leveraged or spread ourselves too thin that we will be hit by something out of the blue. So if that is the scenario, then I don't think one should be overly duly worried about rupee crossing 70. I think those are all sentimental things and won't matter beyond a point. Rupee actually should depreciate. It is more a symptom of what is happening rather than it is causing something. So yeah, incrementally our macros have weakened a little bit. Our current account deficit has widened. The fiscal deficit has been loosened a little bit, and that is what is getting reflected in the rupee. But we are not at 6.5% fiscal deficit. We are at 3.5%, and we will achieve those targets, give or take a little bit. So I am not overly concerned about rupee depreciation.
Hyper growth, hyper valuation get replaced by reasonable growth and reasonable valuations.
Yes.
So let's discuss that once again.
Sure.
When you say hyper growth, are you referring to FMCG companies because they've given double-digit growths? Are you referring to companies like Page Industries and Jubilant Foods because they've given 30% growth? That's hyper growth.
Those are precisely hyper growth combined with fantastic quality of company are getting far superior valuations, rightly so. And as long as the growth continues, I don't see a derating at that point of time. But incrementally, investing in those names is an issue. So the last time we spoke about, I spoke about still sticking with the companies where the growth momentum is still there. But if that growth momentum has been extrapolated 2, 3, 4 years out and is, the price is capturing in, then I think one needs to be a little wary on that front. Within consumer space itself, there are enough companies where there's some or the other issues because of which they are not getting valued like that. And you can incrementally shift your portfolio towards those companies.
But when we have a large political event, which is now even less than 12 months away, some would argue that this market will remain volatile. Capex commitments may not go through. Entrepreneurs and promoters, they want to commit, but they may refrain from committing, which will delay both the demand cycle and the capex cycle. And because of pure uncertainty, defensives may still outperform.
Yeah, so that event providing enough uncertainty and a negative outcome can actually lead to a way better entry point than today. Can't rule that out, but there is no way I mean, when a stock picker comes and talks about macros, be scared. I mean, I have absolutely no sense of how that event is going to pan out. And what I can do is position my portfolio to, I have positioned my portfolio to the economic cycle. And I believe whatever the outcome of that event, that economic cycle is unlikely to be derailed. What happened in 2004, even when the Vajpayee government lost, the economic cycle actually picked up in a big way post that. So can similar thing like that happen? I think it is possible. Though I have no idea on the outcome, but I do believe that the economic cycle is just picking up and we are not done with the economic cycle. So that gives me a lot of comfort in staying invested. Can we have a tactical 10-20% kind of cash raise before the event? All that is possible, but at this point of time, it's too early to think about it.
So you will not take the easy way out, which is that buy 2-3 NBFCs or the popular names like Bajaj Finance or let's say Bandhan or EU Finance, or maybe buy HUL or sit in Britannia. You will not go for the easy approach.
But that's not easy anymore. Everybody is there. So definitely that's the difficult part. Now generating any kind of alpha buying those stocks is next to impossible.
Are you selling consumer names in your portfolio?
So incrementally, as I told you, incrementally we are moving out of companies or stocks where the market has recognized the growth and is factoring in 2-3 years out. Those are the ones that we are incrementally selling and getting into names where market has doubt on FY19 numbers itself. So and reasonable growth and reasonable valuations without any balance sheet issues. I think I would focus on those companies. So there are a lot of themes that are emerging and nature of the market will change over the next 12-18 months.
So what are you buying right now?
So I think tactically with a 3-4 year point of view, I think one should align themselves a little bit more towards the capex oriented. So whether you buy a corporate bank or whether you buy a product engineering company so those are the kind of stocks where there has not been major wealth creation over the last 8-10 years, and I think those stocks can give meaningful return and generate meaningful alpha over the next 3 to 5 years. So I think we are aligning incrementally. It doesn't have to be overnight. I'm just saying that's where the puck is going to be 2-3 years from now, and my job is to look for companies in that space incrementally.
So when you say you're betting on capex, what is the best way to bet on capex?
So whether it is a product company or consumable within industrial, or whether it is an EPC company, our preference is in that order. But again, we would like to, within capex also, you can actually find spaces where a certain sector has moved ahead. Steel capex, once the NCLT is moved out, I mean all the major capacities are absorbed, then probably the steel capex cycle will start. Cement capex has already started. Road capex is already happening. Railway capex is already happening. So which are the companies that are aligned to these sectors and how they can benefit? I mean, I would, in terms of kind of companies, I would like to go with companies with product capabilities and engineering capabilities.
We've discussed the entire diagnostics to healthcare theme in the past. Are you still hot on that space? Because somehow numbers are not there for any of the hospitals. We may make a big picture construct that India needs more hospitals and more hospital beds. But even though there are some fine listed companies out there, somehow numbers are not there.
So the biggest challenge for the hospitals, if I were to take your example of hospitals, is that a particular hospital is profitable, but making that model scalable over a 70 hospital, 100 hospital, 150 hospital is the challenge, because there needs to be enough of your hospitals doing well to take care of your new hospitals that are coming up, because it's a long gestation business. A hospital takes 7-8 years before it break evens and starts throwing cash. So until that business model reaches a scale and size from where the incremental growth does not take away from the base business, those ups and downs are likely to happen. So in the scheme of things, now with the introduction of the new scheme announced, the Ayushman Bharat, one thing is for sure, the insurance penetration in healthcare in India will increase dramatically over the next few years, and that is the single most factor why the healthcare services penetration will also increase. And whether it is a hospital company or a diagnostics chain, they are the secondary beneficiary of this improvement in the healthcare infrastructure.
So would you buy So will you buy hospitals, will you buy diagnostics? Because right now you have 4-5 listed hospital plays, 3-4 diagnostic companies also.
So
You will buy both?
no, so both the spaces are likely to do well, but at the same time, what I would prefer is a company that has gotten its balance sheet together. I mean, and they can fund their own growth through their own without raising too much of funds, and so and execution capabilities need to be above par. So this huge wave is coming where penetration will increase and the services will grow. The guy who has gotten his act already together is the one that will benefit the most. So I would like to align whether it is diagnostics or hospitals. It's not either or for me. I like both the spaces equally. But diagnostics comes slightly at a higher valuation at this point of time, and there is some amount of risk of slowdown because of price cap, or those kind of things exist more on the diagnostic side than on the hospital side. So I am still looking for a bet. Honestly, I have not bet my bet on it, but I'm still looking for I'll keep looking for an opportunity in the space.
Most of the mutual fund managers and PMS fund managers, they are inclined towards financials, and the favorite go-to space has been retail banks and retail NBFCs. Are you looking at changing there as well when you say that get out of crowded trade?
Correct.
Are you changing your
Yes, I think it
approach towards
applies
financials?
as much as it applies to the consumption, the larger FMCG companies, it applies to the retail / private banks as well. That is a crowded space, and nobody can afford even a small hitch over there. So I think with the kind of view that I have on the capex cycle, the credit growth will come back, the corporate lending will come back, and the valuations in that space are very, very reasonable. If I don't have to be right about next quarter or six months from now, if I am right that the capex cycle will pick up in next 2 to 3 years, then that is a fantastic space. The first movers will always be the finances. So corporate banks are the one, and already some kind of movement is already seen, where the corporate banks have started doing well and the private banks are stagnating to some extent. So that's the thing. I mean, you have to position yourself over there, and in a 2-3 year time frame, I'm sure very high probability will be right. Whether we are right in the next 6 months or no, nobody knows.
Now, the pool of corporate banks, or at least the large ones, is only 2 or 3: ICICI Bank, Axis Bank, State Bank of India, BOP, and then you have to take a deep breath as to which is the 5th one. And
Yes.
after the deep breath, you don't want to go beyond BOB.
Sure.
So you'll have to hunt in these 4-5 names only.
4-5 names is more than enough. I don't need a 6th name. Yeah, I mean, why should I even bother about smaller companies? And I have no idea how this space will emerge. So there has been stealth privatization of the PSU banks. They have been losing market share, and they will incrementally continue losing market share. But few well-managed corporate banks from the public sector will also come up who will do well. If you can identify it, great. If you can't, then there are well-known names. You might make less money, but that's safe money to be made as well. So yeah, that's more than enough number of companies for me to look at, and I'll pick and choose probably from those.
You know, whereas optically staple stocks are expensive, Nestle, HUL, Britannia, but if economy picks up, and which is where we are headed, the demand will surprise us, the consumption demand will surprise us on the upside, and new smaller categories will become large categories, whether it is QSR or aviation, a lot of small categories. So which is that one large niche consumer category you are betting on, which could be an interplay between recovery and growth?
So the consumption story that has panned out till now has been more on the discretionary front, indiscretionary front. And what we are betting now is on the indiscretionary front. So see, one thing, if there is one big positive that I hold myself to, is the GST implementation. Till now what we have witnessed is only the benefits of the rate cut in GST. The actual structural benefits of GST implementation will pan out over a medium term when the screws are tightened. So there are still, government has a more benevolent attitude towards the smaller guys, and they are letting them be. They don't want to hurt them. So once the screws are tightened, more and more incrementally the market share will be taken by the larger organized guys. And that story has been delayed to some extent because of delay in e-way bill implementation, or e-way bill implementation not being tight enough. So once that happens, then I think that story that we have all been waiting for, unorganized to organized, will happen, will play out. And if you can find companies who are sectors where there is a large unorganized, and now there has been a 40-50% kind of price correction also in those sectors, then I think with a 3, 4, 5 year point of view, you should bet on those sectors. So I am betting more on the discretionary going forward, consumption space where there is a large unorganized market, and right now there is a movement in the sub 1000 rupee, but this will spread out to higher premiumization and premium category as well.
The binge will start.
Yeah, so right now it is even within consumer, it is a very skewed kind of boom. It's not across the board.
When I saw the Indigo numbers, I started scratching my head. When I saw Jet Airways numbers, my first reaction was, hello, where is pricing power for some of the aviation companies? They're growing, but pricing power is not there. Are you a contra buyer in aviation, or are you avoiding it right now?
No, I'm going to avoid, simply because if they've had the best of growth in terms of passenger traffic growth, and they've had the best of crude prices. If they did not make money hand over fist in that time, then I don't think they'll make it, unless something changes in the industry structure which takes out the supply in a big way. I don't think that pricing power is anytime coming back. And you need to not make the mistake of thinking that these companies will ever have pricing power. It will always remain a cyclical play, and you have to buy it in a down cycle and sell it in an up cycle. I believe that's how it is with aviation companies. Only few companies will stand out, or who will manage their balance sheet in a way that in a tough time they will not lose much, and in an up cycle they'll do well.
So aviation is a big no.
I am not buying, yes.
Okay. One more sector which you've tracked in the past, you've spoken about in the past, you've owned in the past, is specialty chemicals. A lot of variable factors, trade war, this could go wrong, that could go right, and it's very getting complicated. You know, you don't know which Chinese product is coming under tariff, which European product will come under tariff. Has the big picture changed for specialty chemicals?
No, so I continue to believe there is a window of opportunity. China is losing, incrementally losing its competitiveness on the manufacturing side because of 2-3 factors. One is, of course, the US tariff is the latest thing, but otherwise it is the availability of cheap labor, and second is the increasing cost of environmental compliance. Due to these reasons, Indian companies have a window of opportunity. Now, because it is such a tough sector to understand, there exists a research arbitrage. There exists, the understanding is not clear. Market will start believing, okay, these are sustainable numbers, or these are not sustainable numbers, or this is the product that will benefit. There is a lot of scope for going wrong as well. So it is that way a challenging opportunity, but the fact remains that it is a challenging opportunity. So India is roughly about 3-3.5% of the world's chemical manufacturing. I believe over a next 8-10 year period, we'll move to 7-8% kind of a number, and we'll gain that market share from China. That is a long enough runway for a lot of companies to do well. Identifying those companies is the challenge, and identifying the products that will do well. There will be these cyclical ups and downs in various products, and you have to live with that. So you have to have broad enough portfolio of companies as well as broad enough portfolio of products for you to sustain those ups and downs.
You know, investing sometimes could be a very lonely process. You may buy a stock which nobody likes. You may own that business for a couple of quarters, and then only markets recognizes that. So where do you think you are currently feeling lonely? Nobody is in sync with your thought process, but you're yet confident of your thesis.
Yeah. So I mean, just now what we spoke about, I think capex is one theme which has been out of radar of most of
selling consumers is lonely.
Yeah.
But capex, it's been a hot and cold kind of a theme.
Right, but if I believe it would be reflected in the market cap, and if those stock prices haven't moved anywhere for the last 8-10 years, that tells you that it's been an ignored part of the market, and nobody wants to be with a company that is not performing. And whether it is going to be an across the board performing company, I still doubt that. So you will have to do your stock picking within that. But there are many such opportunities which will unfold over the next 3, 4, 5 years. Market is right now not willing to look beyond 6-12 months, and there are enough lonely spots in the market, and I am also owner of some of those where I believe eventually the markets will come around.
Where are you with the crowd? Where you think that, okay, it does not, I don't want to be lonely. I am with the crowd because crowd is getting it right. Everybody will make money.
No, so one space where we have placed some bet and where we believe it is going to pan out, but has not panned out till now, is small finance banks. We have spoken about it in the past, but so NBFCs and the consumer and the related stories in the finance space have panned out, but the SMEs and the vehicle loans, those companies, NBFC becoming a bank, and so that story is yet to pan out in my opinion. Some of them are already valued highly, some of them are not. I think as a space, I still believe it has legs over the next 5 years, 5-10 years.
Last 3 months, what have you read, what have you come across, which in a sense has stayed back with you? Give us an original thought, maybe an idea, or something which in a sense you were able to capture to make your investment process better.
Difficult one. I can't think anything, I mean from the top of my head I am not able to recall anything, but no, there have been a lot of good blogs that I've been reading, and time to time you keep going back to the basic concepts to clear up your mind. There is one Morgan Housel who writes good blogs, then there is Sean Eddings, then there is Intelligent Fanatics. So those are some of the blogs that I've been reading incrementally, and I really like their thought process and how it clears up our mind on how to think about an opportunity. And they take one particular concept, whether it is position sizing or whether it is how to create an idea or how to research, and that has helped me refine my process as well.
In one of your earlier tweets, I think you tweeted a picture with your family in a cricket stadium, right? It was London, I would imagine.
Yeah. That was the Champions Trophy, India-Pakistan game. Yeah.
Ab kya ho raha hai?
Yeah, so I got so yesterday I got a funny tweet, but we should always remember the guys, those who are struggling against the English. Finally, they are the ones who are going to get us the independence.
Well said, but lovely to have you back. Thank you for joining us. Cricket was on a lighter note, but our chat really has been on an interesting note. So
thank you so
your
much.
Time. Thank you for joining us.
Thank you.
That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.